All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm joined here, as always, with Renji Matthew. And today we're going to be talking about a recent interview that Waka Flocka did, talking about how he leverages and uses life insurance to shield his money from taxes, from creditors, from market risk, and also that allows him to become his own banker and use infinite banking. If you've ever heard of those strategies, this is what he's referencing. And we're going to break down this, probably 30-second or so clip that he did in this podcast, talk about how and why it works, and then talk about how these strategies aren't just for the wealthy. Traditionally, the wealthy have used these and have leveraged these for, about the last 100 plus years or so. But you don't have to just be wealthy to use these. We'll talk about how I had a question yesterday, how can the average guy, how can a normal guy do this, right? And we'll talk about that and break it down, how it works for the average person as well. And with that, Renji, anything you want to add before I show the video and we kind of just jump right in?
Sure, go ahead.
All right, let's do it. So I'm going to share my screen and let's go ahead and play the video.
One day I had a friend of mine was like, yo, man, I went to school for being a financial historian. I'm like, what is that?
Yeah.
Like, bro, I don't know what that is. What is that? He was like, bro, we study rich people's spending habits. I was like, oh, snap.
Blew your mind.
What? I became that. I was like the dumbest person ever. I used to just spend money on everything. Man, please.
Yeah.
Please. I'm going to open up an insurance, put $2-3 million in my insurance, and borrow from that and put it back in. I never lose my money, ever.
Okay, so he talks about opening up in insurance and putting $2 to $3 million inside of that, and then going and borrowing from it. So this whole concept is what is referred to as infinite banking. And if this is something that's brand new to you, this may not make sense. If you've already heard of this concept before, this may be something that is familiar. You just may not know all the intricacies of how and why it works. Right. So yes, he does talk about opening insurance, putting $2 to $3 million in there. And then from there, he can go ahead and start to borrow the money. And he mentions to put it back in. Renji, do you want to take us through that? Like, what does he mean by that statement?
Yeah, so it's a cash value life insurance policy. So most people have just heard of term life and whole life, right? And it's if you stop paying 1 or 2 months, that policy cancels, it lapses. But there are life insurance retirement plans out there, or they call it LIRP for short, and it's cash value. So the difference here is you're overfunding the policy. You're not just paying for a death benefit. The whole goal is to keep your death benefit as low as you can so that you grow your money cash value tax free. It's an IRS tax code. We've mentioned taxes on this podcast many times before, and we've talked about how there's almost 77,000 pages in the tax codes with the rules and regulations and everything. And out of that, there's 3 buckets. One is tax now, which is like income, stock, stuff like that. Then there's tax deferred, which is where traditional retirement plans are. Then there's tax free, which is where Roth IRAs, TFRAs, LIRPs all fall into place. So these are all tax codes. And the tax law is to be able to grow your money tax free, to be able to stash your money and protect it from being taxed, you have to have a certain amount of death benefit. So, of course, the way that works is if you're putting in more money, the death benefit has to be higher to support that. If you're putting in less, you don't need a high enough death benefit. You can be lower. Because the whole goal, if you're trying to do it for the cash value growth, you want to have the death benefit as low as possible, just so the cost of insurance is really low and the rest of your money is going to the growth side. So to break it down with simple numbers, the way this works is let's say you're putting in $100, and I'll use my son as an example. He's 5 now. He was 3 when we set him up with one. Let's say if you're putting in $100, $5 goes to the cost of the insurance. Because it is life insurance, so it's based on your age and health and everything. So the younger you are, the better these work, because the cost is going to be a lot less. So in his example, if I'm putting in $100, $5 might be the cost of insurance, 95 is going to the growth side. Same scenario, if I'm setting it up for someone in their 30s or 40s, it might be closer to $20 out of that 100 that's going to the cost. The rest, 80, is going to the growth side. Same scenario, if I'm setting it up for someone in their 50s, it might be closer to that $100 going to the cost. So this is why we talk about, the older you are, it might not make as much sense to you unless you're putting in a lot more money. So the whole goal, to recap, you're trying to keep your death benefit as low as you can so you can grow your money tax free. Because life insurance, other than a Roth, is the only thing that shelters you from the growth being taxed. Any other vehicle you use, the growth of your money that you invest into is going to get taxed. But inside of life insurance, it doesn't get taxed, and it's kind of like we call it a rich man's Roth, because in a Roth IRA, you have a cap on how much you can put in, right? It's the same way with the life insurance side. You have something called a MEC level. It's just like the level that you get on the Roth side. If you go over that, you're subject to penalties and fees and taxes and stuff like that. On the life insurance side, they call it a MEC level, a modern endowment contract. So you want to keep it at that level or below to keep it tax free and growing that money tax free. So, but yeah, that's how these works. And do you want to add anything to that, Kyle?
I think you did a great job explaining overall how it works, and the basis of it to have the cash accumulation is overfunding the policy. And what I mean by that is putting more money into the policy than what is the cost of the insurance, right? So he used the example of his son, and that's a great example, putting in $100 a month compared to the cost of the insurance maybe being like $5 monthly, right? Those are the numbers you said?
Mm-hmm.
Yeah. So when you're
Yep.
doing that extra $95 every single month goes to the cash value and builds up that pot of money, right? And same thing with, what Waka Flocka was talking about here with his investments and what he's doing. He's putting in a large lump sum up front, which is way more than the cost of the insurance. So what happens is that extra money doesn't just, evaporate or just go to the insurance company. It sits in an account that can grow and accrue interest. Different policies can be set up different ways, whether it's just a guaranteed rate of return, or some of them can be linked to like an index where it can grow with, maybe 6, 7, 8% rates of return. But overall, over time, this money sits in this account, right? And how do we typically go and have to borrow or use somebody else's money? If we go to a bank to borrow for a loan, for assets, for investments, to buy a car, whatever, if we go to a bank, we've got to, they're going to check our credit. They may ask us for financial documents. They may go through and make sure that we're suitable enough to even be able to take out a loan, to make sure that we pay back the loan so the bank gets their money. If you save your money inside of your own account, you don't have to go to the bank anymore to borrow their money, right? You can just borrow it from yourself. And most people don't realize that banks use these same type of policies, right? When we get paid, our money typically goes to a bank account. And then from our bank accounts, we have expenses that come off. And then some people with that extra money in their savings, they just keep it inside of their savings accounts, right? Let's say you have $10, $20, $30,000 just sitting inside of a savings account. The bank may give you like 0.1% interest rate, right? They barely pay anything nowadays. But what does the bank do with your 20 grand that's sitting there? They're lending out this money in the form of mortgages, car loans, credit cards, other avenues like that. And then another part of that money, another part of what's called their tier one capital, they're actually buying what's called bank-owned life insurance, or BOLI for short. They're buying these life insurance policies on their top executives to pay out employee benefits, and or if this top executive ever were to pass away, it's going to give the bank some funding to be able to replace this executive. But inside of these accounts, they have the same cash value growth, the same guarantees, the same tax benefits. And some of these companies like Bank of America, I'm sure a lot of you have heard, these banks have over $20 billion worth of life insurance as far as their assets go. So banks are using this as well for a safe place to store money, where it's tax-free, where it's going to grow, and it provides them extra benefits. in the form of the cash value and death benefits should these executives ever pass away, which they're not expecting, right? But it's there just in case. What we can do as individuals, and this is where we kind of get into, it's not just for the wealthy, but instead of keeping all this extra money inside of our savings accounts, save some of this money into your own cash value life insurance because it will grow tax free. It will not be exposed to market risk. And you can borrow from yourself and be able to use this money, which is something back to what Waka Flocka talks about. Hey, I can borrow my money. Now, Renji, let's break down why somebody would want to borrow their money, because I think this is a concept not a lot of people get, because it can be kind of hard to understand leverage, but that's what it is at its core. So talk about how you borrow money from these accounts and why somebody would want to.
Yeah, so the most common way that we see, or what we talk about on this podcast, is using or buying passive income assets, right? So in this scenario, let's say I'll use the simple numbers. Let's say you have 100,000, right? If you went to a bank for a loan, let's say you're putting a down payment for a property that's worth 100,000. If it's an investment property, you need 20% down for most banks. Banks can vary, but on average, it's 20% down, right? So let's say you go to the bank, you got a loan for 100,000 for that mortgage. Now you have to come up with 20,000, either of your own money or another investor's money or something to put down for that down payment, right? In this scenario, let's say you went to the bank, another bank, or a bridge loan for 20,000. You have to pay these loans back in a certain time, by the time with the interest that they charge you, right? Now, let's say in the same scenario, let's say you have in a 401k or an IRA 100,000. You could do the same thing. And I'm tying this to the life insurance side, so hang with me here. Let's say you have 100,000 in a 401k or an IRA, and you borrow 20,000 out of it for that down payment. Same thing with those. You have to negotiate with them the amount of time you would pay that back in and what the interest rate would be. Now, let's say you, God forbid, something happened, you can't pay that back in that time. What happens is you just get penalized that 10% because it would be like you withdraw that 20,000 early and you pay the taxes. Now, if something happens to you, God forbid, and you pass away, your family gets the 80,000 that's left over minus taxes. Now, it's the same scenario in the life insurance side with the cash value life insurance. And something Kyle mentioned earlier, you can either get paid dividends or you could index it. So there's two different types of policies. There's the whole life, and you could do it in an IUL. Differences in the whole life, you're getting paid dividends depending on the insurance company for a percentage every year, be it anywhere between 1 to 5%. Or the index side, it's an IUL where you're indexing with the S&P or some index in the market, so you can get potentially, a lot more growth over time. That's why we like the IUL a little bit better, but you could use it both. So let's say that, going back to that same example, let's say you have 100,000 in cash value in your life insurance policy, and you take out 20,000 out of it. What happens is that 20,000 doesn't come out of your cash value. It comes out of the death benefit. So it acts as if, just like the 401k and IRA, if you have 100,000 and you borrow 20,000, that 100,000 acts as if it was uninterrupted and compounding still in the market. It's the same way the IUL works, or the whole life. It still compounds as if you never touched it. And that 20,000 you borrowed, it comes out of the death benefit. So technically, you don't have to pay it back, because if something happens to you and you pass away, your family still gets 100,000 tax free and whatever it grew to, and they get the death benefit minus that 20 that was borrowed. So if you pay it back, you're just bringing that death benefit back up and the growth back up and stuff like that. But what we talk about, using it for buying assets, same scenario. You take that 20% or 20,000 for that down payment. Now you have a loan with the bank. Now, whenever you make income from rent monthly, you just pay those loans back and replenish it. Now you just rinse and repeat. Do the same thing. You can just keep buying assets like this. And mind you, and as you do this, the loans that you're paying back to the bank, it's not growing your money, right? It's not growing you any interest. The bank's making interest on that. But you're doing the same thing inside the cash value life insurance and growing your money in two places, because that 20,000 that you borrowed, it's still acting as if it was uninterrupted growing, compounding in the cash value life insurance policy, but it's also growing in the asset you just bought. So your same dollar is making money in two places. Now, for those people that don't care about buying assets and just want to retire like a normal, like want to work till 60, 65, whatever, and retire normally, this still works really well because now, like we talk about the secure retirement plans, you have more money at the end, and this, because it's inside a life insurance policy, it's growing tax free also, like a Roth, but with an extra added protection. And you have an added death benefit. So you can take out money every year for retirement and you would have way more non-taxable income because it's inside life insurance that the IRS can't touch because you set it up right. You have more income at retirement too. Anything you want to add there? I know I talked a lot, Kyle.
No, that's okay. All good information. And yeah, like these accounts, why the wealthy love them and why their advisors recommend them to them, because these are the only things in the IRS tax code, the only account in the IRS tax code that can grow tax free, and that is with IRS tax code 7702. You can access the money tax free, and that's with IRS tax code 72E. And then lastly, when we die and pass away, which is going to happen at some point, right, the money inside of the account grows and blossoms and transfers tax free as a death benefit to your loved one. And that's IRS tax code 101A. So the whole idea of this being tax free through all three phases is in the tax code, but there's nothing else that does it. Right. So the rich and the wealthy that want to save on taxes, number one, this makes a lot of sense because they can't start a Roth IRA if they're making more than $200,000 a year. Like this is their only opportunity to do so. And it's not that it's just for the wealthy too, because the average person can't start that. And that's actually one of the questions we got while we were live here is, how much, I forget the exact question, but how much would the average person have to do to start this? And it does depend on you and your goals, but generally speaking, at least take your age and 10x your age. So if you're 33 years old, you should be doing about $330 a month on the low end. Anything lower than that just isn't going to make sense because then your contribution amount is going to be eaten up by the costs of the insurance. But if you can do the 330 or more a month, if you're 33, like you're going to be able to outpace the cost of insurance. You're actually going to have, cash value grow inside of this account. If you're over the age of 50, it's usually like 20 times your age. So 50 and over would have to be like $1,000 a month. And at that point, depending on what other assets you have saved up, there may be other strategies that make more sense. So these do need to be customized and strategized based on you, what your goals are, what you can save, maybe what you've already done for your investments and savings. And that's how we can really determine what's going to make the most sense for you. But that is a really good question. Right. And for those that, do contribute on a monthly basis, think of it like this. You're starting with an account from zero, right? And if you just start contributing, $300 a month, you're not going to have much built up over, 6, 12, 18 months. But that would be more of like a longer term strategy where 5, 10 years from now, you might have 20, 50, 60,000, so you do kind of have to base it based on what your goals are, what you're looking to do. And like anything, the more that you save now, the more you'll have later, right? And as a general rule of thumb, we've talked about this before, we should be saving 15 to 20% of our income for retirement, for investments, and in our savings. And so, people may be watching this saying, well, I can't save anything, right? Money's really tight right now. But if you're making $60,000 a year, that's $5,000 a month. You should be trying to find a way to save $1,000 a month, right? And do that, not because we say so, but do that for you. Imagine being able to save $1,000 a month. Even if you're making $60,000 a year, you're going to be able to save up $60,000 over the course of just 5, 6 short years. So like that's what that rule is designed to do, is to put you in control of your finances and allow you to maybe be able to retire one day to give you the flexibility that maybe in a couple of years from now, you can buy an asset and start building wealth like we talk about, right? So it's not what we say. You don't have to do it, obviously, but if you want to take control of your finances and get financially free before waiting until 65, 70, 75, if you guys haven't seen the recent news, they're talking about raising the retirement age. So if you're below 40 right now, I would say it's very, very uncertain if or when you'll ever be able to retire unless you take control of your personal finances yourself and you start saving up money and doing some of these wealth building strategies that we talk about. And one thing, I don't remember if you mentioned or not, Renji, but another reason to like save your money in here, especially if you had the purpose of going out and acquiring assets, is because if you put it in a 401k, IRA, Roth IRA, doesn't matter. If you're below the age of 59 and a half and you go to try to access this money for investments, for anything else, really, right, there's a 10% penalty. I think you may have touched on it, but I just wanted to harp on it even more that, like, especially if you're young, putting money into these accounts, you're basically putting your money into handcuffs that you can't access until you're 60, 59 and a half, right? Renji, did I miss anything there or anything else you want to add? I think otherwise, I think you can kind of sum it up and wrap us up for today's show.
Yeah. So I didn't mention that. I touched on it, but yeah, these you don't have to wait till 59 and a half. And something I thought of when Kyle was talking too, I've had this question asked to me before. Why would I do this instead of putting money into a bank account? If I want to buy assets, why don't I just put that 300, 500, or 1,000 a month into a bank account and go buy assets? Okay, so here's what I got to say for that. So let's say you do that, right? Now, when you take that money out, let's say over 2 years, 3 years, you saved up 20, 30,000 or 50,000 or whatever. Let's say you take that money in that same scenario that we used earlier to take out 20,000, put into an asset for a down payment. That 20,000 you take out, you put it into the asset. That 20,000 is gotten from your bank. It's in the asset, so it's making you money there. But like I mentioned before, in the cash value life insurance policy, when you take out 20,000 and you put it into the asset, it's still compounding as if you never touched it. So your money's growing in two places, right? And another benefit is the growth. In the bank, it's not growing. In the bank, I think average around the country is 0.05%. So it's less than 1% growth on average. So you're not growing much here. In the cash value life insurance policy, like I said before, depending on which type you go with, you're either getting paid dividends that can be anywhere from 1 to 5%, or you're getting paid depending on the index, which the stock market, the S&P and stuff has done 20, 30% in 1 year. So imagine getting that much growth in your account in the IUL or whole life or whatever. So your money's growing in two ways because it's multiplying while you're still using it to invest in the property, and it's also growing with the market tax free too. I add tax free because again it's protected under the insurance policy. And another thing is, if God forbid something happens to you and you pass away, that money goes to your family that's in the bank account, right? If it doesn't go to probate, so you have to make sure you set up trusts and wills and stuff where it says it goes to your family. But if it doesn't go to probate, they're only getting that 20, 30, or 50, whatever you saved up. In this cash value life insurance, they're not only getting that because you can avoid probate with these because it's life insurance. They're not only getting the money you saved up, they're getting the growth that comes with it tax free. They're also getting the death benefit that comes with it tax free. So your money is multiplied by so much more that goes to your family, right? And I think that's pretty much what I wanted to add to that. To anyone that asks, okay, why would I do this instead of putting money into your bank, right? Anything you want to add before I recap, Kyle?
I do have one thing that I want to add, but I'll say that for the very, very end. So yeah, you can go ahead and are you going to
Okay.
share your screen?
Yeah, I'm going to share
Yeah.
my screen and I'm going to show a couple things. Kyle was talking about how executives use this from big corporations, and then we've also talked about how, something Kyle mentioned, if you make a lot of money, you can't put money into a Roth. I wanted to go over that a little bit too. So before 2010, if you made more than 100,000, You couldn't put money into a Roth. Even now, depending on the state you're in, if you're making more than 150 as an individual or 200, depending on the state you're in, as an individual, you can't put money into a Roth. Of course, there's tax loopholes if you own a business, stuff like that, but traditionally you can't. So what rich people did was they used LIRPs, which is what the cash value life insurance is. And so I'm going to show you examples of rich people that did that, and they went and acquired assets using that too. So I'll recap on all that here. Let me share my screen real quick. Okay, so a few things. This is an example of executives using cash value life insurance. Here, this shows life insurance retirement plans, and this is the traditional retirement plans. And here, your money is getting taxed, and you're not protected from the market. Here, you have protection from the market, and it's growing tax-free. So it's almost 27 times more money in there because it's growing tax-free, right? And then Coach Harbaugh, if anyone was watching this is into football, he used to, back when he was coaching college. This article is from 2017. He was putting most of his money into a cash value life insurance policy. Kyle mentioned banks using policies, or it's bank-owned life insurance, BOLI for short. You can look this up. Big banks like Chase, Wells Fargo, Bank of America, Citi, U.S. Bank, they all put billions with a B into cash value life insurance policy, among other investments that they do because they want to protect their money also and grow it tax-free. This is an example of rich people that use LIRPs. Ray Kroc, Walt Disney, J.C. Penney, they had cash value life insurance policy that they took the cash value out of, and that's how they invested and started McDonald's, Disney, and J.C. Penney. If they can do it, why not us, right? So this is a recap on the LIRP. TFR is another word for it, tax-free retirement account or life insurance retirement plans. And I'm just going to recap on everything we talked about. So there's no stock market risk because you have the zero floor, unlike the traditional retirement plans. There's life insurance included, so when you pass away, your family's not only getting the cash value, they're also getting an added death benefit. There's accelerated terminal benefits in here. We didn't talk about that as much. Loan prepayments, requirements, unrestricted access, be your own banker, all of this goes together. This is where the be your own banker or infinite banking concept comes into place because you can use this as a bank instead of going to the bank for, and again, the example we used was for that down payment, right, for buying an asset. And we talked about how you can access this before 59 and a half. Unlike traditional retirement plans, because this is not like a traditional retirement plan, you can access the money when there's cash value in there. Minimum distributions don't apply here because that's for taxed accounts. In this, you're not taxed. Again, we talked about the umbrella of insurance, so you're protected from being taxed. Earnings excess, tax-free, not included in income because income is taxed, right? And then we talked about everything going to the heirs tax-free. And one thing too, this cannot be altered by changes in law. Of course, you're grandfathered in if the laws are changing and stuff, but what we found is a lot of governors and senators use these in place, so they don't want to change the law. Again, they would be grandfathered in if it did, but the reason they wouldn't want to change the laws is then they can't set these up on their kids and grandkids, right? So just a few things to think about, like that's a recap on everything. Is there anything that I forgot, Kyle, or anything you want to add to anything?
No, nothing that you forgot and nothing that I want to add. Just kind of want to summarize everything up and wrap it up with, really just at the end of the day, and I guess as like a disclaimer, right? In the medical field, you have, I'm sure we've all experienced very good doctors versus, maybe some bad doctors. And I guess not that there's any bad doctors out there, but just maybe inexperienced, right? Or maybe not much time in their practice, right? In the financial world, it's similar, right? There are people that are specialists with these accounts. These are people that are just newly licensed. They may not know how and why it works. They may not have access to all these different companies, but as always, nothing on this is intended to be taken as financial investment advice. Always seek one-on-one consultations with someone that's a specialist. In the medical field, it's called medicinal malpractice if a doctor makes a prescription without prior diagnosis, right? Understanding what's wrong, what's going on, and what your goals are. Financially speaking, it's the same thing, right? Don't take any of this advice from just our show and go out and make any decisions. We would prefer, you guys meet with a specialist one-on-one, talk about your goals, talk about your savings, and just learn the pros and cons of these different types of accounts, and just to see if it's right for you. Do your research. When doing your research, you may see that there are some negative comments out there. There are some people that have had bad experiences with these accounts, people that have had really great experiences with these accounts, right? And the only difference that it came down to was how the insurance was designed, right? If you remember anything from this podcast, you want to have minimum death benefit for maximum cash value. So write that down, embrace it in your mind. And if you ever go to look at this, and if you're ever talking to somebody, mention those words and make sure that the advisor or whoever that you're meeting with can describe to you exactly how that policy meets the goal of minimum death benefit for maximum cash accumulation. Renji and I are specialists in this. We've helped thousands of clients set these up together. And if you guys want to find some time to see if this would be something that's right for you, let us know. You can reach out to us on TikTok, Instagram, Facebook, or even I think you can message us here through YouTube, but you may not be able to. So seek us out on one of those other social platforms. We are here to help. And I think with that, that's a good way to end and wrap up our show here, talking about Waka Flocka and how the other wealthy people of the world have leveraged insurance to help them build wealth and to do it tax-free and with other protections in place too. Hope you guys have a great rest of your day, and we'll see you on the next episode. Take care.